Alright, hello everyone, and welcome to the final fast recap I'm going to be doing, which is Unit 3, AOS 3, Australia and the World Economy. Let's get straight into what we are doing here. So, Australia and the World Economy is all about the relationship between trade, money coming in and out of Australia from other countries, money going out of Australia, the effect that has on the Australian dollar, net foreign debt, current account, all those kind of things. So trade means that consumers have access to more goods and services than they would otherwise, and usually it's cheaper and they have more choice, which improves material and non-material living standards. Trade means that businesses have access to a far larger market, as well as also having access to cheaper imports to use in production, which can lower their overall production costs. Also helps them achieve economies of scale production, which means their fixed costs become a smaller proportion of their overall costs. Trade also means that businesses and governments have access to cheaper and high quality resources. The balance of payments is components. So the balance of payments is a financial record of all the money coming into and out of Australia in a financial year. So it's broken down into the current account on one side and capital and financial accounts on the other side. This is the current account, currently in surplus, important to know. So it's broken down into 4 sub-accounts. Net goods, which is imports and exports. Net services, which is imports and exports of services. Net private incomes, which includes credits and debits of salaries, interest payments on foreign debt, dividends, etc. And net secondary incomes, which is one-way transactions with no expectation in return, such as foreign aid. So then we have the capital account, which deals with the transfer of funds into and out of Australia, mainly due to migration. So this obviously at the moment is incredibly low. It's massively negative as we don't have any migration coming into Australia. We've got the financial account, which has a few sub-accounts. The main 2 that are important are the direct investment, which is investing in land or businesses in Australia or overseas. We usually categorize any direct investment as anything more than 10% of the value of that. Portfolio investment is investing in shares, bonds, non-changeable nature, anything non-physical that you can invest in. And RBA assets is a stock of gold, currency, etc. held by the RBA in case they need to use it at any point in time. They've got errors and omissions, which works out to make the whole thing balance out. Because it's like a set of scales, the 2 sides need to be totally in balance. Terrible scales right there. Why am I using time on that? So we've got cyclical factors which impact our current account. So how changing levels of economic activity and aggregate demand impact the current account. So when we are in an expansion, a lot of spending starts spilling over onto imports, which therefore increases the amount of debits into the current account, which either decreases our current account surplus or increases the size of the current account deficit if you're currently in a deficit. The opposite is also true. If we're in a contraction, it means we stop spending on imports and focus on domestic spending. Therefore, there is less debits leaving the country and the current account is better off for it. There are structural factors which are long-term, usually AS-based reasons why Australia's current account has historically been in deficit. Australia is a relatively young country, which requires constant investment to make use of our resources and increase our capacity. And because we have a high household indebtedness ratio, this means we need to do that with foreign funds because we can't borrow from Australians because we don't have any savings. Another cause are low international levels of international competitiveness due to low efficiency and high costs, like our wage cost is a major part of that. The relationship between the current account and the financial account, usually any transaction in the capital financial account has a follow-up transaction that occurs in the current account. So if someone invests in a business by a net direct investment, this means that there'll then be a debit in net primary incomes as profits, etc. are leaving the country. So then we've got net foreign debt and net foreign equities. Net foreign debt is the balance of all funds Australia has borrowed from overseas against what we have borrowed out, essentially. So this includes both public and private debt. Public debt is government debt, private debt is from household and businesses. Then we've got net foreign equities, which is the same thing, but the balance of assets owned by Australians overseas versus the assets owned by overseas countries in Australia. Net foreign debt in Australia is currently over $1 trillion, so $1 trillion in net foreign debt. And our public debt is approaching $1 trillion on its own. We've got the terms of trade, which is a ratio of average prices received for exports divided by the average prices paid for imports. Terms of trade assumes that quantities remain constant. So if export prices go up, we're assuming we're still selling the same amount of exports. Therefore, that's why we are better off. Therefore, if export prices increase on average and or import prices decrease on average, this is a favorable aggregate demand side factor. Factors that may influence the terms of trade are changing the exchange rate, economic activity of our trading partners, especially China. That's what's affecting it at the moment. That's why it's so high at the moment. It's currently 127. Whenever you talk about the terms of trade, you need to talk about either export prices increasing relative to import prices. So an increase in the terms of trade means that either more export credits are coming in or less import debits are going out in the balance of trade. This means increased aggregate demand, which leads to increased economic growth, decreased unemployment, and upward pressure on inflation. Also increased material living standards, as average incomes are likely to rise due to decreased unemployment. If import prices have fallen, on average, this could be lead to increased choice satisfaction by households as they have more purchasing power, which is great. The exchange rate is the value of our currency compared to another currency, usually the US dollar. Anything that increases the demand for Australian dollars in the foreign exchange market will lead to an exchange rate appreciation. Anything that decreases the demand for the Australian dollar on the foreign exchange market will lead to an exchange rate depreciation. So if the exchange rate appreciates, this means that there will be less demand for our exports and more demand for imports, which reduces the balance of trade. It means we're likely to decrease our current account surplus overall. An appreciated exchange rate does, however, mean that we're more able to repay our foreign debt, as $1 is now worth a lot more against another currency. An exchange rate appreciation can also be favorable for aggregate supply, as it can decrease the cost of production for businesses who use imports as factors of production. So things that impact our international competitiveness, the main reason why Australia struggles to be internationally competitive is that we have incredibly high wage rates compared to most of the world. We do, however, have high stocks of natural resources such as iron ore, which are in high demand for countries like China, which have been benefiting us in our trade for a long period of time now. Then the effect of trade liberalisation on Australia's international competitiveness, domestic macroeconomic goals, and living standards. To trade liberalisation means the removal of trade barriers between nations. This means that businesses are exposed to increased international competition and must be as productive as possible to remain competitive. This also means that consumers and businesses have access to more choice and cheaper resources from overseas. So the main thing with this recently is China has recently been increasing barriers to trade to Australia. So tariffs on barley, wine, etc. try and hurt our trade relationship, as we accuse them of being the basis of COVID, basically. But this hasn't been enough to offset the benefit of China's increased demand for iron ore in the economic recovery, because they need that to make steel. So therefore, China's growth has benefited us anyway, even though they are putting barriers to trade. So that's it for Unit 3, Aerospace 3. That covers everything in a very, very short period of time. If you have any questions about it, show it at runningeconomy.com, or head to the runningeconomy.com, or anywhere on this YouTube channel for all videos about this area of study. If you need more detail at all, if you have any questions about anything at all, feel free to hit me up. Other than that, I hope you have a wonderful day, and I'll see you next time. Bye.